Accounting terms. As you progress through your agricultural science course, you should know the concepts that are relevant to keeping farm accounts and records. Understanding these accounting terms is important to completely understanding your farm's financial health and success. Farm assets. A farm asset is anything of value in the possession of the farm's business. Assets can be fixed or current. Fixed assets are assets that are not used up during production. These are capital inputs of the farm and can be used for multiple years. In agriculture, examples of fixed assets include farm buildings, tools, vehicles, machinery, and landed property. Current assets are assets which are used up during production. These are farm supplies involved in the farm's production. They need to be replenished. In agriculture, examples of current assets are agrochemicals, seeds, water for irrigation, and cash that is in the farm's bank account. Cost. Costs are the expenses required during production. There are two types of cost, fixed and variable. Together, the fixed and variable costs create the total cost. Fixed costs are costs associated with the production that do not vary regardless of the amount of product generated. In agriculture, fixed costs would include the payments for insurance, full-time employees' salaries, lease payments for equipment, or rental costs for land. Variable costs are costs that vary directly with the level of production. In agriculture, these costs include the cost of seeds, fertilizer, agrochemicals, and wages for hourly labor. Liabilities. Liabilities are monies owed to outside individuals, agencies, or businesses such as banks. There are two types of liabilities, short-term and long-term. Short-term liabilities are also known as current liabilities. These debts must be repaid within one accounting year. In agriculture, examples of current liabilities include purchases on credit, taxes owed, long-term liabilities due, and unearned revenue, such as a deposit made in expectation of a product delivery. Long-term liabilities are debts that cannot be paid within an accounting year. In agriculture, examples of these debts include loans to purchase land, buildings, new machinery, and large and/or expensive equipment. Gross and net. The adjective gross describes the total amount before subtracting necessary expenses. For instance, your gross salary is the amount you receive before any taxes or other fees are removed. Gross is used to modify other accounting terms such as profit, income, and revenue. In agriculture, a farm's gross revenue is the amount that the farm gains from sales. The adjective net describes the amount remaining after subtracting necessary expenses. For instance, your net salary is the amount you receive after taxes and other fees are removed. Net is used to modify other accounting terms such as worth and income. In agriculture, a farm's net profit is the take-home amount, the number that the farm earns, figuratively nets, after expenses have been paid. Revenue and profit. Revenue is the total money earned from the sale of goods and services. Profit is the amount of money earned after the expenses associated with the business are paid. Revenue minus expenses equals profit. Net worth. Net worth, sometimes known as net capital, is the complete worth of an individual, household, or company. Net worth is the value of assets and liabilities combined. Assets minus liabilities equals net worth. Liquidity. Liquidity is the ability of an individual, household, or business to pay debts as needed. An asset that is liquid can be easily transferred into cash to pay debts directly. In agriculture, machinery and harvested crops are assets. However, those assets are not liquid. In order for those assets to be liquidated, they would need to be sold for cash. Solvency. Solvency is the ability of an individual, household, or business to pay debts after liquidation. A solvent entity is able to eliminate debts after the assets are liquidated. In agriculture, a farm is solvent if it no longer has liabilities after its assets, crops, tools, etc. are liquidated. Equity. Equity is the difference between the values of the assets and liabilities of a business. Equity can include stocks and other non-liquid assets. A business has negative equity if their liabilities are greater than their assets. However, negative equity could be a sign that a business is growing or starting a new enterprise. Equity is not generally measured in agriculture, but could be relevant if your farm is part of a cooperative or other organization with shared responsibilities. Appreciation. An asset that grows in value over time is said to appreciate. Appreciation increases profits as the cost at purchase is lower than the cost at the time of sale. In agriculture, examples of appreciation include purchases of land, livestock maturation, and the cultivation of cash crops, crops grown for commercial value instead of the farmer's use. Depreciation. An asset that depreciates loses its worth over time. Depreciation demonstrates the loss of value in the market due to age, wear and tear, and/or the demand for the asset. In agriculture, farm machinery, tools, vehicles, and technologies are significant assets that depreciate over their lifetime. Useful lifespan. The useful lifespan is the number of years that an asset such as a piece of machinery can serve the farmer effectively. The best agricultural example of the useful lifespan is a tractor or other vehicle. The vehicle can only serve a farm efficiently for a number of years before the costs of repair are greater than the costs of replacement. Salvage value. The salvage value of an asset is the amount at which it is more economical to sell off the asset than to repair or maintain it. The amount that you would obtain by salvaging the asset is the salvage value. Calculating depreciation. Since the value of an asset can depreciate over time, the loss of value can be deducted as a business expense. In some countries, that decrease in value is deductible from annual taxes. As of the fall of 2021, Nigeria does not currently allow for depreciation as a tax deduction. It is still helpful to know how to calculate yearly depreciation for your farm's accounting. Depreciation. Before calculating the amount of annual depreciation, you have to determine the total amount of depreciation. To do this, subtract the salvage value of the asset from its cost. For the purposes of this illustration, let's assume that a farm's tractor originally cost 200,000 naira. The farmer determines that the useful life of the tractor is generally 10 years and the salvage value of the tractor is 50,000 naira. Original cost 200,000 naira, useful lifespan 10 years, salvage value 50,000 naira. Total depreciation is the original cost minus the salvage value. The easiest method to calculate annual depreciation is to divide the total depreciation by the useful lifespan. Annual depreciation equals total depreciation divided by the useful lifespan. In this example, the cost of the tractor depreciates by 15,000 naira per year.